Larry Hoffman here with LJH Investments, and I just want to take a few minutes and just talk about what is note investing and why I choose it over being a landlord. So what is note investing? Really, it's just a fancy name for paper investing, just investing in mortgages, deeds of trust, mortgage notes, or I'm sorry, promissory notes. It's all lumped into this. Contract for deeds, and contract for deeds are a little different, and I can do another video on the differences between contract for deeds and mortgages, deeds of trust. You have, wraparound mortgages, all-inclusive deeds of trust, and it boils down to there are two types of paper. You have unsecured and secured. So unsecured is very risky for the person holding the note. There are no liens, no collateral, typically in an unsecured note. It boils down to the character of the borrower, and really the only recourse is to sue if the borrower defaults. And if the borrower doesn't have any assets, I mean, you're pretty much out of luck. You could file, you could go to small claims court, right, and levy a judgment against them. But if they have nothing, you won't be getting anything. And this is why I invest in secured paper. It's backed by a promissory note. It has a mortgage, which is a lien. And if the borrower defaults, we can foreclose on the property. And if we actually foreclose on it, we actually receive title to the property, and we can either keep it or sell it. And like I said, I only buy secured assets. I like safety, and I only buy assets that are backed by a tangible asset. In other words, real estate. So just to kind of go over a little bit, a couple terms here that I was initially talking about. We have a promissory note and a mortgage. A promissory note is just written, it's basically just an IOU. It's a written promise to pay, and it outlines the terms, the interest rate, the monthly payments, the length of the note, and then the mortgage is basically just a lien that is tied to the promissory note. So it secures the promissory note, and this is what actually gives you the legal right to foreclose on the property. So other terms that come into this, you have a mortgagor and a mortgagee, and the mortgagor is the payer. They are the people making the payments to the note or on the note, and the mortgagee is the payee, and this is the company that's receiving the payments to the note. So the borrowers are making payments to the bank. In this case, when I buy them, I become the bank, right? So when this note's actually sold, instead of the borrowers making the payments to the bank, they actually make it to me now. So, and then I can go into other training on how, like the documents and how all that stuff works. But this is just really like a kind of like a 30,000 foot view of what note investing actually is. And when we're talking about investing in mortgages or notes or paper, there are different positions that these mortgages are in, or notes are in. You have a first position, a second position, and I've seen third positions, and I've actually seen fourth positions. Typically, like the first and the second. I don't buy second mortgages. I only buy first position mortgages. Just because they are more secured, and I like to be in that sense of security in that position. And just to kind of give you an example of a note that I typically would buy. So what I did was I just made this up. It's just a fictitious property. The fair market value on the property is $100,000. It has an unpaid principal balance. That's what UPB stands for, unpaid principal balance. $54,000. It has an interest rate of 7.5%. Principal and interest payments of $451. That's not including taxes and insurance. That's either part of the mortgage or the note, right? Whether the payments are escrowed or not. But this is just assuming these are just strict principal and interest payments, with a term of 221 months left. And what is that? That's about 18 years. So the difference between the $100,000 and the $54,000 gives this owner a $46,000 equity, right? And so when I come in and I actually buy this, I'm typically looking at a 14% yield on my money. So what I would often do is, and that's where you have to learn about how to use your financial calculator to figure all this stuff out. I would make an offer of $32,900. So this includes, like my due diligence cost and my servicing costs and things like that. So you typically the yield is appears to be higher, but when you factor in all these other due diligence costs, what I like is like I said, is about a 14% return on my money. So I'm going to offer $32,900, and the delta between the $54,000 and the $32,900 is $21,100. And you may be saying, well, Larry, why in the world would they take that such a steep haircut discount? People become motivated. They need the money. They just want out of it. They no longer want to receive these payments anymore. And this kind of goes into another topic where you have performing and non-performing notes. Maybe this was a reperforming note that they were just looking to get out from underneath, or maybe this is a performing note that went non-performing just recently, right? Non-performing is typically less than 30 days or greater. But there are a lot of different reasons why people sell things at discounts, and and the only thing that you could do is just make an offer, and I've done this a lot of times where the offer wasn't accepted at first, and then 30, 60, 90 days later, I follow back up with them and my offer is accepted. So hopefully that kind of explains what note investing is. And if you have any questions at all, please feel free to reach out to me. My cell is 513-301-1468. Shoot me an email, larry@ljhinvestments.com, or you can schedule a 30-minute call with talkwithlarryhoffman.com, or find me on LinkedIn at Lawrence J. Hoffman Jr., or visit my website, ljhinvestments.com. Once again, if you have any questions about anything, please feel free to reach out to me. I'll talk to you guys later. Thanks.